Welcome back to another episode of the Multifamily Masterclass. I'm Bart Diehl, the Director of Investor Relations here at Neighborhood Ventures. And today, the co-host is Jamison Manwaring, our CEO.
All right, good to be here.
So the purpose of this podcast today is to answer some of the most general questions that we get on a daily basis. I'm meeting with investors nonstop, and we're excited to dive into it. Getting to the first question we have is, what are the potential risks associated with investing in multifamily properties?
Yeah, I'm frequently talking to investors about this as well. And when you look at the different risks between different types of investments, they all have different risks. So if you look at, generically investing in the stock market, one of the biggest risks are the liquidity behind that stock. Could mean that people start selling it. There's short sellers, there's quant funds, and your investment in the stock could go down very quickly because the value at the end of every day, you know how much your stock is worth. When you invest in private real estate, like what we do at Neighborhood Ventures, it's a very different risk profile. And this is part of why I left Wall Street and I was an equity analyst covering software stocks, and they moved around all the time. It wasn't uncommon to have a stock go up 50% post earnings or down 50% post earnings if they didn't hit the numbers. And those are huge swings, what we call volatility. And when we look at investing in private real estate, part of the reason why I was drawn to it was because I am not someone who loves volatility. I kind of like even kill,
slow and steady.
Slow and steady. We call it up and to the right. That's because if you look at any stock chart, that's what you want it to do. Just keep going up. And long term, to build wealth, that's how you really do it. Warren Buffett's first rule of investing is don't lose money. So if you have that philosophy, if you're patient, and if you don't like the ups and downs, private real estate is a great way to invest. And the biggest risk to private real estate is when you're working with a team. You're going to have an operations team, which is what we are at Neighborhood Ventures. We do everything from acquiring the building to doing the property management to collecting rent every month, doing renovations on the building if we're going to do the renovations. And the team needs to know what they're doing. So there is some risk in the team itself. If they blow through a budget on the renovations, if they go over budget, if they don't do good on the lease up, that can really hurt your returns as a private real estate investor. The biggest risk is if they put leverage or debt on the property, and if they're not able to pay that debt back, that's where some equity holders could actually lose their entire investment. So that's the biggest risk when it comes to investing in private real estate, is if the first lien holder, the debt holder, doesn't get paid, then they can take the whole property. That's the biggest risk. And that's why it's important when you take a look at an investment to see how much debt is there relative to the total value. We call that the loan to value ratio. And it's not unlike if you're buying a home. And what happened in 2008 when people bought homes with no down payment, when the values went down, they walked away from the home because they had no equity in it. They had no skin in the game. They didn't lose anything if they walked away. And that's the same thing when you invest in a private real estate deal, is how much equity is there. If the bank is 60% or less, I consider that moderate to low debt. If you're above 60%, if you're 75 or 80%, that's quite a bit of debt. And not necessarily if it's on your own home, but on a commercial real estate project, that's higher debt. And that's the biggest risk when it comes to commercial real estate.
Yeah, and typically with anything, more debt equals more risk.
Absolutely. And that's what you want to look for first. Neighborhood Ventures, we are conservative operators, so we keep our debt low. We like below 60%. Most of our projects are below 60%, especially as they get leased up and the construction loan gets completed.
Yeah, so you touched on operators. There's definitely a risk with operators, but given the current high interest rate environment, could you shed light as to what we're seeing in the market right now?
Yeah, so we launched our opportunistic fund a few months ago. because we started seeing some operators, especially those who bought properties in 2021 to 2022 and last year, who bought kind of at the high end of the market, and interest rates went from 3.5% to 7%, 7.5%. And those operators, many of them are starting to have some problems with the property. Either they're not meeting their debt service, or their loan is coming due and they're not able to refinance it. We started seeing some of that, and it doesn't happen very publicly like a single family home. If you can remember 2008, great financial crisis, it's very visible and very conspicuous when it happens to a single family home, because you can see the for sale sign, you can see the foreclosure sign, people are moving out. When this happens with apartment buildings, it tends to happen quietly, and that's what's happening right now. There are apartment owners who are in that financial distress, and they are selling the buildings quietly. They're moving off of them. In some cases, they're leaving all their equity behind. And in some cases, the bank is taking it back and quietly selling that to someone else, which you can do with private debt with an apartment building. So we started seeing that a few months ago. It isn't widespread.
Yeah.
You know, it's a very small percent of the total. Most apartment owners have a lot of equity, and operationally, the apartments are doing very well. We have good, strong rents. We have high occupancy. That's what we're seeing for our Neighborhood Ventures properties. But some are having challenges, and that's why we launched our distress fund. And I can tell you, since we launched the fund, we have probably on average looked at 2 or 3 deals per week. We've gotten close on a few. We're very picky. We want to buy it right. As we talk about often with real estate, you make your money at the purchase. So if you think about that, if you purchase something wrong, you're probably not going to make any money, no matter how long it takes, and no matter how much work you put into it.
Yeah.
You got to buy it right. So we've seen several of these deals already. We haven't had one that really was hit the bullseye. But there's been several of these every week that we're looking at. And investors, some of whom also invest with us, are starting to get what are called capital calls from some of these projects they were involved with. This is where the company calls and says, hey, investor, we need you to put in more money to make this project viable. And in many cases, if they don't put in more money, they can lose their equity that they already have. You've gotten some of these calls as well.
Yeah. Yeah, I've talked with plenty of investors who have called us preemptively worried that we might be doing capital calls, and that's not the case for us. You know, a credit to Jamison and John back in 2020 when so many people were buying, they slowed down. They said, hey, this looks like we're going to be at the top of this thing, and there might be a little bit of a crash. And we're seeing that today where investors are getting these capital calls, and that's the risk that we're talking about. It's higher the debt, the higher the risk.
Yeah, and I wouldn't call it a crash because it's so small. It's a really small percent. But it's the first time since the great financial crisis in 2008 where we're seeing some distress in multifamily. Multifamily, it's like the best real estate asset to own. And that's part of why we're in this business. Rent is paid first when people pay their bills. So it's a great asset to own. And it's rare you can actually get a good deal on an apartment building in a market like Phoenix. And we're seeing a few of them, but it's a very small percent.
So you just talked about how multifamily real estate is such a great asset to own. Why do you consider it such a strong option for real estate, for capital preservation? Yeah,
and when you talk about capital preservation, people mean, I want to just hold my money. I don't want to lose it. Going back to Warren Buffett's number one rule, don't lose money. That's what it means for capital preservation. How do I put my money away outside of cutting a hole in my mattress and putting it all in my mattress? And one of the most favorite ways for wealthy people to do that is in commercial real estate, specifically multifamily. And that's because the value of real estate over time tends to be very stable. So unlike the volatility you get with the stock market where it's up and down, real estate tends to be stable. The cash flows are also stable. You can see that on an apartment building. You might have a 50-unit apartment building. If you lose a couple of tenants, you still have 48 that are going to be paying.
Yeah.
And if you have a larger apartment building, it's even better because you have that diversity of income. So there's so many benefits. And then one of the biggest benefits is that there's also a lot of tax benefits that helps offset costs. I'm mostly talking about depreciation and then also 1031 exchanges when you sell a building. So real estate is a great way to preserve your capital. Sometimes it's not going to be the high flyer. It's not NVIDIA, which is up, another 100-something% this year. It's not up and down like Bitcoin. It's more steady, but a great place to put your capital, get good double-digit returns in most cases every year, and have some really good tax benefits as well.
Well, the last question I have is, when we're reviewing deals that are on our table, how do we evaluate what we're going to buy versus what we're not going to buy?
Yeah, you have to be really disciplined when it comes to buying assets, because when you go buy an asset, it's like you've adopted a child. You really have to go all in on that asset. You have to understand everything about it, the good, the bad. You take it all. If there's a problem with the roof or leaky pipes, that's on you once you own it. So as the owner, we get all that fun stuff. And you have to be able to foot the bill when that kind of stuff comes up. And so we're real picky about the assets that we require. We have a very disciplined approach to only buying the assets that fit our criteria. Mm-hmm. Our criteria is we want to be in the core and core plus areas that are near population centers, employment areas, the freeways, mass transit,
public parks,
public amenities that are walkable. We're investing in those areas because they tend to do better if there's a recession than some of the outlying tertiary areas and tertiary cities. So we're in those core areas. Those are the ones that we like. We also like areas that are up and coming. So even though we'll look at properties that are in already well-established areas, we like some of these that are on the move over the next few years that are going to move up in value. That's just one way to get a little bit more better return if you can time that well. So we spend a lot of time in those neighborhoods. We understand the neighborhoods well. We don't buy in areas that we don't understand because we want to be on the upswing in some of those neighborhoods. And don't fool yourself. Some neighborhoods look like they're on the upswing and they're actually on the downswing. And you don't want to be going on the downswing of a property either. So you really need to understand what's happening in a community to take that community up or down.
What are some indicators that would show the difference between upswing and downswing?
Ultimately, it comes down to investment and interest. So if you go to a neighborhood and you see people are spending money on remodeling those properties, that you see some fresh restaurants that are moving in there doing a build out, that you see the government spending money on better streets and better schools in that area versus areas where you think, oh, this is real close to this area. It's pretty adjacent. It should do well. And you go in there and you just don't see that investment. That's one thing that's a telltale sign. Yeah. Because in order to move the needle on an area, there has to be investment of dollars. And I think in addition to that, you have to look at the macro environment. You have to look at if the government is friendly to growth and to development there. Yeah. And that's both the city and the state government. Those cities and when the city and the state get behind an area and they want to redevelop it, those things will last years and will drive redevelopment in that area for extended period of time. So you kind of have to look at the micro view, which is the local, what's happening at street level, then the macro view, the more government and higher viewpoint. Thank you for listening to our podcast, the Multifamily Masterclass. Please subscribe to get all of our new episodes.